You know what drives me absolutely crazy? Watching people throw money into the stock market like they're feeding coins into a slot machine while completely ignoring the fact that they're carrying credit card debt, charging them 22% interest. It's like trying to fill a bucket that has massive holes in the bottom and then wondering why the water never stays. And this is one of the biggest mistakes people make when trying to build wealth. They want to jump straight into investing, picking stocks, buying crypto, chasing the next big opportunity, and hoping their money starts growing. But there's a problem if you're doing things in the wrong order. You can spend years investing and still make almost no real progress. There is actually a smarter sequence for putting your money to work, and following that order can save you thousands of dollars over your lifetime, while making your path toward financial freedom much smoother. The problem is, the correct order isn't always exciting. It starts with the boring stuff. Think about building a house. You wouldn't spend all your money on expensive furniture and beautiful decorations if the foundation was cracked and the roof was leaking. But that's exactly what people do with their finances. They get excited about the latest stock or trendy investment while carrying high-interest debt, having almost no emergency savings, and ignoring the financial foundation underneath everything. And that can become incredibly expensive. Before you worry about making your money grow, you need to make sure one unexpected expense won't completely destroy your progress. That means building an emergency fund. I know, it sounds boring. Nobody gets excited about saving money for a car repair or an unexpected bill. People would much rather hear about the stock that could double next year. But an emergency fund is about more than just having cash sitting in a bank account. It gives you breathing room. Imagine your car suddenly breaks down, or you get hit with a large unexpected bill. Without savings, you may have only two choices: sell your investments at the worst possible time, or put the expense on a credit card and start paying ridiculous interest. With an emergency fund, you can handle the problem without destroying everything else you've been building. So how much should you keep? The usual advice is 3 to 6 months of living expenses, but the right number depends on your situation. If you have a stable job and strong benefits, you may feel comfortable with around 3 months. If your income is unpredictable, you're self-employed, or your industry is unstable, you may want 6 months or even more. But don't let a huge number scare you. Start with your first $1,000. That first $1,000 can cover many of the smaller emergencies that normally push people into debt. Then work toward 1 month of expenses. After that, keep building until you reach your target. The important thing is getting started, because once you have that financial cushion, something changes psychologically. You stop feeling like every unexpected expense is a disaster. You have options, and having options is one of the most valuable things money can give you. Once your emergency fund is in place, the next major problem to attack is high-interest debt. This is where things get serious. If you have credit card debt charging something like 20% or more, investing while carrying that balance can be incredibly difficult to justify. Why? Because paying off that debt gives you a guaranteed return equal to the interest rate you're avoiding. If your credit card is charging you 22%, every dollar you use to eliminate that balance is effectively saving you from losing another 22% to interest. The stock market might give you strong returns over the long term, but it doesn't guarantee them. Your credit card company, however, is very happy to guarantee that interest charge. Imagine you have $5,000 in credit card debt at 22% interest, and you only make minimum payments. Over several years, you can end up paying thousands of dollars just in interest. That's money that could have been building your wealth instead. So list every debt you have, route down the balance, the interest rate, and the minimum payment. Keep making the minimum payment on everything, but put your extra money toward the debt with the highest interest rate first. That's the debt avalanche method. It may not feel exciting, but mathematically, it can save you the most money. There is, however, one important exception. If your employer offers a retirement plan with a matching contribution, you should usually contribute enough to receive the full match before aggressively attacking the rest of your high-interest debt. Why? Because employer matching can be an immediate return on your money. For example, imagine your employer matches 50 cents for every dollar you contribute, up to a certain percentage of your salary. You contribute $3,000, and your employer adds another $1,500. You just received a 50% return before your investments even had a chance to grow. That's extremely difficult to ignore, so contribute enough to get the full employer match. Then take your extra money and go back to destroying that high-interest debt. Once the debt is gone, you can increase your retirement contributions. Now you've reached a completely different stage. Your emergency fund protects you. Your high-interest debt is no longer draining you, and you're collecting the free money available through your employer. Now it's time to think about taxes. This is where a lot of people make another mistake. They open a regular taxable investment account and start investing there without first taking advantage of the tax benefits available through retirement accounts. Your money should generally get as much help from the tax system as possible before you start giving the government a cut of your investment growth year after year. One important option is an IRA. An IRA can give you more control over your investments and, depending on the account and your situation, valuable tax advantages. You can invest in low-cost funds and build a diversified portfolio without being limited to the investment choices inside your employer's retirement plan. And those fees matter. A difference that looks tiny on paper can become a huge amount of money over several decades, because every dollar lost to unnecessary fees is a dollar that no longer compounds for you. Then comes another major decision. Traditional or Roth, the basic question is simple. Do you want the tax benefit now or later? With a traditional account, you may receive a tax benefit today, but you generally pay taxes when you withdraw the money later. With a Roth account, you pay taxes up front, and qualified withdrawals in retirement can be tax-free. So if you're currently earning a lot and expect to be in a lower tax bracket later, a traditional account may make more sense. If you're early in your career and currently paying taxes at a lower rate, a Roth can be very attractive. And if you genuinely don't know what your future tax situation will look like, having a combination of both can give you more flexibility later. Then there's an account that many people completely overlook, the HSA. If you have access to one, it can be incredibly powerful because it offers multiple tax advantages. You can potentially receive a tax deduction for contributions, your investments can grow tax-free, and qualified withdrawals for medical expenses can also be tax-free. That combination is rare, and healthcare is one expense you can almost guarantee you'll have eventually. If you can afford to pay current medical expenses out of pocket, one strategy is to keep your HSA invested and save your medical receipts. That allows the money to potentially keep growing for years while preserving your ability to reimburse yourself later for qualified expenses. After age 65, the account becomes even more flexible. Non-medical withdrawals are generally taxed like traditional retirement withdrawals, while qualified medical expenses can still be withdrawn tax-free. That makes the HSA more than just an account for today's medical bills. It can become another piece of your retirement strategy. Once you've taken advantage of your HSA, you can go back to your employer retirement plan and contribute beyond the amount needed for the match. At this point, you're building serious momentum. Your emergency fund protects your progress. Your debt is no longer eating away at your income. Your employer is contributing money. Your retirement accounts are receiving tax advantages. And now your investments have room to compound, but there's still one final place your money can go: a taxable investment account. This is where most people want to start, but it's actually where you should usually arrive after taking care of the other priorities. The advantage is flexibility. There are retirement account contribution limits in the same way, and you can access the money whenever you need it. Maybe you're saving for a house. Maybe you want to retire early. Maybe you need money for a goal that doesn't fit neatly inside a retirement account. A taxable account can give you that flexibility. But remember, it doesn't come without a cost. Dividends can create taxes. Selling investments at a profit can create capital gains taxes. That tax drag can quietly reduce the amount of money that remains invested and compounding for you. So taxable investing isn't bad. It's just usually more powerful after you've already taken advantage of the tax-advantaged options available to you. And that brings us to the bigger picture. The goal isn't to find some magical investment that makes you rich overnight. The goal is to stop unnecessary money leaks, protect yourself from financial emergencies, eliminate expensive debt, collect every benefit available to you, reduce your tax burden, and then let your investments compound for as long as possible. The order matters: emergency fund, high-interest debt, employer, match, IRA, HSA, if eligible, then maximize your retirement plan, and finally, taxable investments. It might not be the most exciting strategy in the world, but wealth is rarely built by doing the most exciting thing. It's built by doing the right things consistently for a very long time. While everyone else is chasing the next hot stock, you're quietly building a financial system that gets stronger every year, and eventually that boring strategy starts doing something incredible. It starts working without you. Your money compounds, your debt disappears, your investments grow, and the decisions you made years earlier begin paying you back. Your future self won't care whether you picked the hottest stock of the year. Your future self will care that you built the foundation first. Because sometimes the smartest way to get rich isn't finding a shortcut. It's simply doing things in the right order.